Welcome to Trading Pro. In our previous lessons, we've completed the basics and familiarized ourselves with fundamental candlestick patterns. Today, we begin the second part of our tutorial, where we'll learn about basic structures and patterns. Price movement consistently follows certain behavioral patterns. If you can master these, it'll greatly assist in your chart reading and trading execution. In this part of the tutorial, I'll break down these structures into three sections: trend pullbacks, trading ranges, and trend reversals. We'll start with trend pullbacks, which can be divided into simple and complex pullbacks. A simple pullback refers to a one or two segment movement, whereas a complex pullback involves multiple segments. Before we dive in, I want to emphasize a point I've made many times. If you're still new to trading, don't rush to apply what you've learned to live trading. Each pattern has numerous variations, and when a pattern fails, it might immediately form a new structure. Furthermore, a pattern's meaning can vary depending on its position and the current market condition. Until you've fully integrated what you've learned, these fluctuations can be difficult to manage. Most beginners learn patterns like double tops and bottoms and head and shoulders, but often they rush into trading and suffer heavy losses. That's what I'm talking about. In the later part of my video series, I'll guide you on how to apply the knowledge you've acquired seamlessly. So, don't rush. In the early stages of learning, your focus should be on understanding the content, retrospecting, and reflecting on it. If you have questions, feel free to ask me. Let's first take a look at a specific example of a simple pullback. The spot marked by the red arrow in the chart is a very standard simple pullback pattern. I will use this pattern to explain the definition and precautions of a simple pullback. Taking an upward trend as an example, first, there needs to be a round of strong and clear trend movement, which ideally breaks through a consolidation range. The breakout should be substantial so that everyone looking at the chart can feel that the bulls have taken control of the market. This is a prerequisite because a clear trend is required for a pullback. If a rapid movement in a fluctuating range does not break through a key point, then the major players in the market will not regard it as a clear trend, and the concept of a pullback will not apply. Secondly, the retracement should also be simple and clear, not a horizontal overlap of candlesticks. Horizontal overlapping candlesticks represent areas of price congestion. After the price pullback and the uptrend, this trading range becomes a clear resistance for the uptrend. We do not want to encounter such clear resistance in the direction of price advancement after we enter the market, which would be a disadvantage for our trading. So the second point of trading this pattern is that the pullback should be simple and clear. The third point is that there needs to be an entry pattern. This example is excellent as it shows the three common entry patterns we use, which we will discuss in a moment. Finally, this pullback should ideally be the initial pullback of the trend. If a trend has been running for a long time without a complex pullback, and it has always been a simple pullback, it might soon face a lengthy complex pullback. If a trend has been running for a while, it's best not to trade a simple pullback anymore. To summarize the conditions for a simple pullback to occur, firstly, there needs to be a rapid trend movement, which must make one feel a clear trend force. It is best if it breaks through a clear consolidation range, breaks through a clear wave point, and ideally breaks through substantially, so that both the long and short participants in the market see it as a clear trend movement. We aim to follow this strong trend force. Secondly, the retracement should be simple and clear, not overly horizontal overlapping candlesticks. If there are too many horizontal overlapping candlesticks in the pullback, it forms a small trading range, which after our entry becomes a clear resistance in the direction of price advancement. This is something we do not wish to see. Lastly, it is best not to be a long-running trend without a pullback, as such trends are prone to long periods of complex pullback. If a trend has been running for a long time, those who established positions early in the trend would have profited significantly, and they might start to close their positions to take profits. Counter-trend traders who are waiting on the sidelines will also seize this opportunity to enter the market to fight for control. Since the market may face a complex pullback, we should avoid such operations. Next, I will bring you through actual examples to understand how to operate this simple pullback pattern. Let's look at the first example. Now that you've got this chart, what would you do when the price reaches here? First, you need to mark out the key levels of the market and see what the market is doing. When the price moves to this point, it first rises rapidly, breaks through a converging range and a key swing point, and does so significantly. The market is clearly bullish at the moment. Then the price undergoes a simple pullback, a simple retracement. We can see that there are almost no overlapping candlesticks with two long bearish trend candlesticks and then a reversal candlestick. Now, the price is just retracing the swing point and it's around the 20 EMA. The 20 EMA is one of our reference indicators. The area above and below the 20 EMA is our reference area for entering on a simple pullback. We can't over-rely on this indicator. What is this reversal candlestick reversing? It's reversing this pullback trend, reversing to the trend direction. Where does it appear? It appears at the retest of the level. It appears near the 20 EMA. Then it is a very good signal candlestick. How do we enter? We wait for the price to break through and then enter, or we set a breakout order. When the next candlestick's price breaks the previous candlestick's high, we enter. Some people, when they see the reversal candlestick, they directly enter. This is one way, but I don't really recommend it, because when the market has a reversal candlestick, it is a signal. This signal needs to be confirmed by the price breaking through. Sometimes, such a candlestick may not break through at all and just keep falling. Then what about the people who just entered directly? They got trapped. I personally wait for it to break before entering. Let's look at the next candlestick. The next candlestick is our entry candlestick. This previous reversal candlestick is called a signal candlestick. It is our entry signal. We only enter on the next one. Now this pattern is called a first breakout, also known as a higher high one. I personally like to see a higher high 2, which is a second breakout, before entering. Let's see how the price goes next. After our entry candlestick, followed by two doji candlesticks. Actually, this is not a particularly good signal, because after we enter, we hope to see a continuous bullish force. But it formed two doji candlesticks, which means the price is still stalling. The third candlestick, which is the current one, it has surpassed the previous candlestick's high point. This is higher high 2. This is the entry pattern we talked about in the last class. It represents the second bullish force. Let's continue looking. After the higher high 2 entry, the market produced a candlestick that represents bearish power. We can see a lot of overlapping arrangement of the price here. This is a representation of a trading range, representing a pause in the bearish energy. At this time, for those who have not entered the market, they might choose to enter when the range breaks, also known as a box breakout. To summarize the several entry patterns that appeared in this chart, first breakout, second breakout, and box breakout. These are the most commonly used entry patterns when we do simple pullbacks. Let's continue. This bullish candlestick represents a strong bullish momentum. It tells us that the bulls are forcefully pushing the market. No matter which signal we choose to enter, the entry signal is confirmed. Regarding profit taking, stop loss, and order management, they will be covered in later lessons. For now, just understand how to trade this pattern. Let's move on to the second case. When you get a chart, you need to understand what the market is doing. Mark out the key levels first. So what is the market doing? First, there is a strong rise in the market followed by a pullback. This pullback is a multi-stage complex pullback, which we will discuss later. After the pullback ends, the market continues in the previous upward direction, but this round of momentum quickly depletes. It tells us that the bulls are reluctant to continue buying in, and the bullish power is not enough to push it to break through the key swing point in front. Actually, there is a failed breakout of low to short pattern here, but let's leave it for later. We're just talking about simple pullbacks in this video. After the market's upward momentum waned and broke below the key level, it tells us something. The bulls have completely given up. They're not even willing to defend the level that has been defended multiple times. The bulls are only willing to buy at a lower price. As for how low it will go, you have to look at the specific price performance. After the price breaks down, it quickly rebounds, and the rebound is at the moving average. When the price moves to this point, we should start looking for entry patterns. First, we can see a lower low one, but it was rejected by the market. I've said before that I don't really recommend doing the first breakout. So why was this signal rejected? Actually, it's also quite easy to understand. Because there are already 3 overlapping candlesticks in front, it's a trading range. Trading ranges are prone to such false breakouts. The key signal candlestick is here. It's a small candlestick. The good thing about a small candlestick as a signal candlestick is that the stop loss is narrow. Secondly, after this candlestick broke through the previous high point, it formed a very long bearish candlestick, which represents a false breakout upwards. If this signal candlestick is broken down, it will be a lower low 2, also known as a second breakout entry pattern. So when the price breaks below the previous candlestick's low, I will enter to go short. I might directly set a breakout order to enter short. Alright, let's take a look at the subsequent trend. The subsequent trend is also simple. It just confirmed our short signal. Let me summarize again. First, the market background allowed us to go short. It went up, adjusted, lost momentum on the rise, and broke down. The market is leaning towards short. Under the leaning towards short, there was a rapid fall in energy, a rapid rise in retracement, and a second breakout entry pattern appeared. We entered short and simply made a profit. Alright, that's for today's video. In the next lesson, we will continue simple pullback cases. And if you like this content, please like, comment, and subscribe so you won't miss out. And I'll see you in the next video.